everyone, welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Talib Sheikh, manager of the JPMorgan Global Macro Opportunities Fund. Hi Talib.
Hi there.
So I know that you have a thematic investment process and there are 8 themes which help govern your investment decisions, and you've recently added a new theme, haven't you, to this investment process?
That's right. Those themes really are the core of how we build a portfolio. We try and break the world down into things which we think will drive price action for many months and many years. And you're right, we've just added a new theme to the portfolio. It's called Japan Beyond Abenomics. And I think it's interesting, but it's starting to explore the idea about 7 years since the end of the great financial crisis. Japan's into its second lost decade. Have central bankers run out of policy tools? Are we reaching the end of the road? We've seen central bankers around the world cut interest rates to zero, engage in long-term asset purchases or engage in QE, a number of rounds of QE. And more recently, we've seen central bankers try and take interest rates negative. And I think the thing that makes the theme interesting is that the market perception of that has been actually taken quite negatively. So we've seen the market going from really thinking that negative interest rates meant free money, and that was positive for risk assets. We're actually seeing it work back the other way. And people are starting to debate, what tools do they have left in Japan? Could they engage in more QE? Well, 20-year JGBs yield 25 basis points if they go to zero. What difference will that make? Could they buy equities? Maybe. That's something which is still left on the table. But it's clear they're getting towards the end of that prescription. What does that mean? It means that the risks to the downside probably increasing from here. And also for end investors, it means that many of those low risk go-to type of assets, government bonds, investment grade credit, actually no longer have any yield in them. People have to look more broadly and people have to build a more diversified portfolio. So I think it's interesting, and I think it also applies much more broadly than just purely for Japan. We think of Japan almost as the testing ground for this idea.
Well, as you say, Japan is the guinea pig, really, but these are tools which we may well find ourselves needing in the West. You've got Janet Yellen in the US being very dovish about interest rate rises for this year because the global macroeconomic outlook is muted for growth. So where Japan goes, is there a case that we may follow?
I think so. You've seen that in Europe. Clearly, Europe have got negative interest rates from the central bank. You've seen them desperately trying to get banks to lend. And actually, even in Europe, as long as a bank makes some meets some relatively lackluster hurdles in terms of expanding its credit book, they can actually receive negative interest rates from the ECB. It's one of the reasons, one of our other themes is European gradual growth recovery. It's one of the reasons why we think that many of those high-quality dividend-yielding stocks across Europe actually look reasonably decent value from here. But I think the key thing, as you point out, is that global growth is just not as strong as people have expected. We're 7 years since the great financial crisis, and we're really not seeing that exit trajectory or that acceleration in a way that we've seen historically. And I think that some of that is still to play through. I think it means that asset prices, certainly within risk assets, are likely to be more muted going forward. It means that the hunt for yield probably continues and probably broadens. And also it means that diversification in portfolios is probably harder to find. The risk that you have to take in order to harness those yields is probably a little bit harder, and having to work harder to deliver a portfolio that's well diversified, I think just becomes more problematic because of the structural world that we find ourselves in.
So in short, investors just accept that this point in the cycle it's going to be slow growth, low growth, not just for the economy but for asset classes as well?
I think so. I think we've seen risk-adjusted returns of long-only assets degrade quite quickly, really, over the last year or so. In many ways, we saw that happen in August of 2015 when we saw bonds lose money, fixed income lose money, and credit lose money. I think those kind of episodes are likely to be more frequent. Certainly, when we look at valuations across most developed markets, we wouldn't argue that equities are massively overvalued here, but equally, we're struggling to find lots of value. So returns are likely to be a bit more muted. The risk-adjusted returns are likely to be less, and the correlations between asset classes likely to become more unstable. So having a portfolio that's appropriately diversified, I think, is going to become even more critical going forward.
Talib, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.